On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to The Money Path. I am your host, Todd Schoenberger, and joining me today is Shana Sissel. She is the CEO and founder of Banríon Capital Management. Shana, we had a volatile sell-off on Friday. As you know, the S&P 500 was down 2.7% after President Trump came out and talked about the, quote, massive tariffs on China imports. That volatility is actually carried over into this trading week. Then there was a report that came out, though, over the weekend talking about leveraged ETFs and how they may have played a hand in the volatility that took place on Friday. Is this a reach, or is there some validity to that statement?
No, there's validity to that statement. Let's kind of get to the structure of a levered ETF. This is not true for all levered ETFs, but any ETF that uses the word leveraged in their name, uh, more often than not, is getting leveraged through derivatives, right?
Okay.
So any kind of option contracts, futures, things of that nature, those types of instruments are volatility instruments, right? So expiration dates matter, the spreads, the Greeks, all of that plays into that. But at the end of the day, derivative instruments are instruments that are moved and can move volatility and actually express a view through volatility. So to suggest that that might have had something to do with a rise in volatility of the markets is not that big a reach, particularly because we've seen such a massive amount of levered ETFs come to the market in all different flavors. So
Yeah, you're right about that. And to add to that as well, for the audience on the leverage side, what that means is that there is that leverage component that's built into the ETF. So if the
Mhm.
S&P, if you have an S&P 500 ETF, if it goes up 1%, well, chances are it might act your ETF is going to go up 2% because there's extra leverage.
Yeah,
But the
the
inverse of that is true too.
yeah, so the ETFs themselves typically have that in their name. It will be 2 times levered S&P, 3 times levered S&P. It'll say 2 times levered S&P daily, 2 times levered S&P monthly, 2 times daily S&P quarterly, meaning that the leverage is either on the daily price, the monthly price, or the quarterly price. And so they reset on that, the daily being the most volatile and the most risky, and kind of going from there. I always like to point out that leverage in and of itself is not a dirty word and inherently not bad. How you express that leverage matters. Synthetic leverage, like derivatives and options, and the things that these types of ETFs are doing, are using synthetic leverage, which tends to have a higher risk associated with it than, say, a traditional leverage, which is like borrowing at a lower rate than your expected return of what you would use that money to, that you're borrowing that money to buy. Think about your house, a mortgage, that's leverage, your credit cards, that's leverage. But synthetic leverage, which is using derivatives, is different. You're basically getting exposure through a synthetic vehicle, and then they kind of Russian nesting dolls. You can get a derivative on a derivative on a derivative on a derivative. The further you get away from the underlying, the higher and the more risk you're taking on because you have
Ooh,
less transparency,
yeah.
and it's more sensitive to volatility overall. But yeah, so that's how that works. And most levered ETFs, and you can have 2 times levered and 2 times inverse levered, to your point, where you're going and you're making a bet in the opposite direction.
Yeah, you got that right. And I got to say, that's some high octane right there. I mean, if you're an investor, that's probably not for your typical mom and pop type of investor, I would presume, correct?
It's not. In fact, if you go to any of the websites for these vehicles, they typically say on them, this is a trading instrument. It should not be held more than a day, or however long if it resets monthly, you shouldn't hold it more than a month, things of that nature. But it's more than just the levered ETFs. I mean, obviously those have grown. Levered crypto ETFs are becoming a thing. You're seeing that more and more. But also buffer ETFs, which are quite popular, also employ the same type of leverage because they're gaining their exposure for the buffer through derivative option contracts.
Hmm.
They're just pairing it with a zero coupon treasury typically, but it's still getting leveraged exposure to an underlying instrument through a derivative contract.
Interesting. So you are the queen of alternatives, so that's your title. And so you obviously know what you're talking about when it comes to these leveraged ETFs. The question I have for you though is that, and you know the numbers way better than I do, but I actually was able to find out that we have about $100 billion that's sitting out there in equity leveraged ETFs. Do you think that's enough to make that kind of a move though, to send the S&P lower by 2.7%? Because then the follow-up question is then that's very dangerous, isn't it, for the overall stock market?
Yeah, you got to remember it's levered. There's $100 billion of assets in that, but if it's two times levered, it's
Hmm.
$200 billion of exposure. And
Yeah.
these instruments you can get three times, four times, and in Europe they can go up to 20 times. So inherent leverage means that your $100 billion is $200 billion of exposure. Now, to your point, you wouldn't think that that would necessarily move markets, but again, there's two times, three times leverage. So you're leveraging on top of actual exposure. So it's more than just the net assets that are invested in these products. Their actual exposures are levered. And I want to just point out that yes, this can happen. If you recall, I believe it was 2010 or 2011. Do you remember the fat finger day?
Yes, absolutely.
Okay, do you
It's
know what
historic.
caused? Do you know what caused the fat finger day?
Well, I would assume somebody with fat fingers, but explain for the audience.
It actually wasn't. It was a derivative trade being done in a mutual fund that was run by Ivy Asset Management. It was their global allocation fund, which was a global macro fund that used derivatives to express views on certain markets. And that fat finger trade was specific to that fund. Again, exposure is magnified because it's a derivative, but if one mutual fund could do that in a day back then why wouldn't a group of and that fund did not have $100 billion in it. Do you see what I'm saying? Like
I
it
know
can
what you're saying.
absolutely affect the markets. Also keeping in mind that we were going into a holiday, there was less volume, and all of those things come into play as well.
Interesting. Well, that's some brilliant analysis there. Well, let's turn the page then. With alternatives, now you have this volatile market. I know we've been getting some solid bank earnings over the past 48 hours, but what do you think as far as alternative investments to close out the year? Are there any specific themes that you'd recommend to investors?
Themes, not so much. I will say I kind of think of alts in the same way you would think of equity and fixed income. I'm all about putting together portfolios for a longer term time horizon and not making specific tactical bets in one type of strategy. We'll
Okay.
say there's a lot of talk about private credit and private equity right now. Those are in the alternative universe, but I would argue that they're not and should not be allocated to as alternatives. They're equity and fixed income, and they should be part of your equity and fixed income allocations. The conversation surrounds liquidity more than anything. Those markets are really interesting. We're definitely seeing more and more interest in them and more access to them as new vehicles come to market. Interval funds are interesting. I think there's currently today, as it stands, there's a website you can go to. It's not the best website in the world. It has way too many pop-ups, but it's called intervaltracker.com. And
Intervaltracker.com. Okay.
intervalfundtracker.com.
Oh, okay.
And you can see all the interval funds that are currently out in the market. I think there's about 300 of them, but you can also see how many funds have submitted registrations to the SEC that are pending and where that their registration status stands on that site. And there's almost three times more interval funds that are pending registration to what's actually in the market, which speaks to these things are coming fast and furious. And a lot of focus has been on whether or not it's becoming overheated, specifically private credit. That's the big one. And I would argue that the private credit markets may actually dwarf the public credit markets today and actually may be more liquid than the
Hmm.
public markets today. And as with anything, there's nuance here. So most of those strategies and products that are coming to market to the broad audience that people are putting in money into are managed by really big players playing, and they're all competing for really big deals and very large cap spaces, right? So, there's a lot of money that's chasing after very few number of deals because just if you think about just market cap in general, right, there's a lot more small cap companies. That's why we have, the Russell 2000 and the Russell 1000, 1,000 large cap companies to 2,000
Right.
small cap. There's always more smaller cap names and larger cap names. So in private credit, it works kind of the same. So upper market credit, there's not a lot of deals to be done. And so there's a lot of money flowing into few deals, and that is causing the valuations of those deals to be, at a massive premium and possibly overvalued in a massive way. I would argue though, we have a lot of private credit on our platform, and I talk to these managers a lot. They play in what I call the lower middle market, which is like typical deal size of $1 to $2 million. They're typically helping fund small businesses, startups that are having a hard time accessing capital through venture, early stage, things of that nature. Companies that need capital that banks are not necessarily willing to, or they need it quickly. So, like getting an SBA loan takes so long, things of that nature. These are private credit. We have one client that tells us all the time they see probably 200 deals a month and maybe do one. So they
Wow.
have more pricing power. They have more power in being able to dictate terms that are favorable, and they have a ton of opportunity to really be particular on the deals that they do decide to do. This particular company is very geographic focused to the Pacific Northwest, and they only work with asset heavy companies. So, if you think about the Pacific Northwest, that's a very asset light area. It's a lot of tech companies. They only deal with asset heavy. So it's a very specific market, but they get tons and tons of requests for capital. So when you look at private credit, you do have to look at the nuance. I would agree that the upper end, where you have the Apollos and the KKRs and the Blackstones, all those firms that have billions of dollars they have to put to work. And you're not going to be able to do that in small $1 million loans, right? You're
Right.
looking to lend and have deals that are in the billions. Those firms are chasing very small deal opportunities. They don't have as much ability to dictate terms, and they're basically bidding against each other. As you go down market, though, this situation is completely different. And so, in the private credit market, I would argue there's actually more opportunity down market. That's just not what's coming to market in these like interval funds and other products that are accessible to the average investor.
Okay, so that's on the private credit. Now on private equity, as I know you're a sports fan, you're a New England Patriots fan, and the Big Ten Conference recently announced a $2 billion private equity fund, which sounds like an alternative investment to me.
It is.
Any idea though? I mean, if you're an investor or an accredited investor, you want to get into this type of fund, what exactly am I investing in though? I mean, University of Maryland lacrosse. I mean, what exactly would it be?
No, you would never invest in the University of Maryland lacrosse. You'd be either you're investing in the conference, and that is the rights to how the conference generates profits, which is mostly media rights. That's actually a massive opportunity. So I love talking about this. The sexy part is the, Big Ten. It's
Oh yeah.
the New England Patriots just sold a small portion of the ownership to a private equity firm. We're
Hmm.
seeing that more and more, as owners don't necessarily want to give up control, but they certainly would be willing to monetize at elevated valuations because they
Hmm.
can, and it's new to the market. But the real opportunity that lies in sports is actually not there. That's just the sexy part. It's actually what we call emerging sports. So, like, think about the WNBA, think
Mm.
about, F1 racing, golf. Now we have like golf leagues that compete with the PGA. We had
Mm.
all that happen. We have, flag football. Tom Brady is now working with a sovereign wealth fund in the Middle East to create a flag football league. And so those opportunities are the most interesting. And why is that? Media rights, the opportunity for to gain a lot of value through media rights, because that's
Mm.
how most sports actualize and gain profitability, is massive, because now we have streaming services, and we live in a world where back in the day, the way that all of the networks and the cable programming made money was through selling advertising. We live in
Yes.
a world where I can now fast forward through advertising, choose to watch without commercials, right?
Right.
So what is the only thing, or you can choose to watch it later, record it, watch it later, and fast forward. Okay. What is the only thing you can't do that with? It's live sports, because I mean, technically you could, but if you already know the outcome, why would you?
Why
Um,
would you
and
watch?
and right, people want to watch that live. So the value of those advertising spots during a live broadcast of sports are massive, which is why every streaming service on earth is trying to get rights to NFL, is trying to get rights to MLB and NBA. Why? Because their platforms are not advertising based. Now they're starting to come out with ad based where you can get a lower subscription fee, but most people will pay a premium so they don't have to watch ads. They can't do that with live sports. That's the only thing that you can actually, and now instead of every single TV show and every single broadcast network being able to generate ad revenue at any time during the day, the most advertising and the premium that they can charge is always going to be during the live sports. And so that's why, even these smaller sports, if Apple TV or Netflix gets the rights to F1, there's a segment of people that will watch that and want to watch that. And then they can, in turn, get advertising dollars. They're also creating programming around it to generate interest in these sports. You don't need a lot of people to be able to generate a premium amount of money for an ad spot during a live event.
Yeah, that's brilliant. That's absolutely brilliant because that is actually the entire streaming business model. And
Exactly.
so, yeah, and you're going out. I mean, and plus on the flip side of that, here the Big Ten is selling media. They're going to share in revenue produced
By the
from, was it
media.
like, I don't know how many schools are in the Big
There's
Ten.
way more than 10 now.
Yeah, way more than 10.
I am an Iowa fan, so I'm a
Okay.
Big Ten person. Obviously, I'm in the Chicago area. Northwestern is literally in my backyard. And so at Big Ten, everything here, right?
Yeah.
So the Big Ten now, because now they have premium brands, they always had Ohio State and Michigan, but now they got UCLA, now they got Washington, now they got, USC. Those are also premium brands
Yes.
that they're able to negotiate better media rates as the conferences kind of collapse upon themselves. And like basically right now, it's just the SEC and the Big Ten have all the power and all the best brands in college sports. They can negotiate premium deals with the networks and the broadcasting channels and the web services, you name it. They're able to do that. They're able to sell the branding rights. Now you have, name, image, likeness opportunities. Same idea. All of those things come from sports. This is all new. I think it's a really interesting and exciting time. But I always like to remind people the most attractive opportunities in sports is actually not the stuff that's the sexiest. It's the stuff that's benefiting because of the collapse of the conferences, because of the collapse in ad revenue generation, and you need to just have live events in order to get premium ad revenue. And it doesn't matter what the live event is. There's enough of an audience that you can charge that premium fee, and that's really where all the revenue is coming from. So yeah, there's tons of opportunity there. Also, you're seeing more and more these professional sports teams create experiential. So I was talking to somebody the other day, and I won't mention it, what owner it was and what team it was. But this owner was buying all the real estate around the stadium that they owned for this professional sports team, and they were doing it so that they could create hotels and
Oh yeah.
bars and shopping. Just like I'm from Massachusetts, Patriot Place. People
Yep.
go there whether there's a game or not. You can generate all kinds of revenue from that. I live
Yeah.
in Chicago. Wrigley Field, up until maybe 10 years ago, when Theo came in and things changed, wasn't necessarily monetizing the area around it. Now go down there. They have Gallagher's Way where they do movie nights when there's no games. You can go down there anytime you want during Christmas. They put an ice rink out there. Now they have high-end hotels and high-end restaurants and shops in Wrigley. And they're able to monetize that because they own the real estate surrounding it. So again, that's another thing that happens in these sports rights funds and another way to monetize sports.
Yeah, it's like the Walt Disney Orlando model because when he left Southern California, he saw Disneyland. I mean, there's all these little riffraff stores across the street from Disneyland, but when he went to Disney World, he started buying up all the property around the actual theme park, and that was the whole idea
Hmm.
of being able to build out and control the narrative, so to speak. And it sounds like that's a brilliant idea, especially when you think of why professional teams build stadiums in the middle of parking lots like they're doing in Buffalo, New York, doesn't
Hmm.
make a lot of sense. So maybe that's the grand plan to put up hotels and
Well,
everything.
I mean, they want to, because if you only rely on game day to generate revenue for the real estate, you've already lost. But if you can
Uh,
create an experience for
yes.
fans to want to go there even when there's no game, like years ago was in Dallas, and we did a tour of, Cowboy Stadium. It was not a game day. We got to go into the locker rooms, take pictures. People eat that up. Fenway Park does the same thing. And those opportunities, that's how you monetize non-game day revenue, having concerts. But if you do that, you got to have places for people to stay, places for people to shop, places for people to eat, and create the whole experience so that people want to go there and spend more than a couple hours.
Yeah, yeah. So let me ask you a question then. So would it be, say, taking the Big Ten example, the $2 billion private equity fund that they're creating, but that's overall for the entire conference. Can an individual school do the same thing? Because after all, student athletes now are participating in revenues through NIL. Can investors do the same thing?
So boosters, yes. Whether or not an individual school could do that, it would depend largely on their relationships with the conference they belong to. Notre Dame might be able to.
Good
Notre
point.
Dame has an independent football program, negotiates their own media rights. That's actually what makes Notre Dame such an important program and why a lot of people hate them. Notre Dame's had an exclusive Notre Dame only deal with the NBC for as long as I can
That's
think of,
right.
right? They negotiated that themselves. That's why they want to stay independent, though, so that they can't, the conference can't, veto these things. That's why they have been so adamant about football doesn't join a conference because they are able to monetize through the NBC contracts and other licensing deals. Individuals can do that, but if they belong to the conference for that, they couldn't do that. So if unless they're an independent school and unless they're independent for the reasons Notre Dame is, you couldn't do that. Most schools don't have enough cachet necessarily to be attractive for media rights or anything on their own. There might be a few, but they're in conferences, and I
Right.
would probably guess that they're not at all excited to leave a conference, even if they thought they could do the Notre Dame model. Notre Dame's model has been that model for like 100 years.
Yeah, yeah. No, you're right. I mean, could you imagine if you take, say, the SEC, and then you have a team that wants to break out like an LSU or an Auburn, and they do something like this, and they become even wealthier than they already are, then how's a school like a Vanderbilt going to compete with that? So, yeah, that makes a
Exactly.
lot of sense to me. So let's turn the page off of sports then. So give me some other alternatives that you're telling investors. Are you thinking art? You thinking, I don't know, what? Just come up with any. I mean, I'm sure from the alternative side, there's so many to choose from that are unique. Are your clients asking for any specific areas that we're not discussing so far?
So we've talked about all the sexy stuff. Now I'm going to talk about the unsexy stuff.
All
But
right.
in my opinion, the part that people aren't paying enough attention to. So I wrote some curriculum for the Kaya Association's Certificate of Fundamentals of Alternatives several years ago, and the part of the curriculum I wrote was around the idea of what are alternatives, what are diversifying alternatives, and what are just like private equity that are alternatives because of structure. And it's actually the diversifying alternatives that I find people pay the least amount of attention to, but they should probably pay more attention to. It's things like managed futures, global macro, long short equity, equity market neutral, real estate debt, arbitrage, activism, event driven, special situations, distressed. Those types of things, which are typically done in a hedge fund form, actually are broadly available in ETFs and mutual funds and interval funds. And those are your diversifying alts. In the market, the way it has been, and if you look, and we actually run an ETF model for Wisdom Tree, and I'm pretty proud of the performance that we have with that model. The model itself I've been running since my times at Orion in 2018, so it has a
Hmm.
track record. But if you look and you build those portfolios with those diversifying alternatives, and you make it a 20% allocation across your portfolio, they can actually provide a really attractive risk reward. Not necessarily adding much to your excess return. And I always like to caveat with that. People automatically think alts and think it's sexy and high flying and whatever. A lot of the
Yeah.
stuff is not like that. You don't buy it because you think it's going to crush the S&P. You buy it because it has some sort of characteristic that can, help mitigate risk or manage risk and things of that nature. And then you just like you do with equity and fixed income. You put the parts together and you get a nice little portfolio that in its cohesiveness is able to provide you, equity-like returns without equity risk. And what typically happens is, if you look, JP Morgan has something they put out every quarter called the Guide to Alternatives, and they have a consistent chart in that report that they show, a portfolio that has 30% alternatives in it. I think it's like 30 alternatives, 20 fixed income, 50% equity. And what it consistently shows over time is that it increases the overall return on an annualized basis of the portfolio by maybe like 30 or 50 basis points. So again, nothing you're gonna like celebrate, but when you start compounding that, it makes a difference. But what the biggest thing it does is it ends up reducing the overall standard deviation, volatility, and risk of the portfolio anywhere between 25 and 35%, which, when it comes down to it, the portfolio most people want to be in is the one that they can stick with. And if you can reduce the vol and the movements up and down, they're more likely to stick with that portfolio. So, there's new and interesting ways that people are coming about doing it. There's this concept of return stacking, which we started this conversation talking about leverage. This is in bad leverage. So I would argue return stacking is good leverage, where they're basically using leverage to take a 60-40, and instead of having to choose, like, where do I take money out of so I can put in alts, they just lever that 60-40 and then take the money they get through that leverage, whether it be through debt or otherwise, and they invest it in alts. And what you would do is obviously invest in an alts portfolio that has expected returns that are higher than the cost of the leverage that you're using to get that. And you'll hear the numbers. This is going to be, I swear to you, 5 years from now, you're going to be like, Shana was the one who told me, and she was right. You're going to hear the term 90-60 a lot. And that's where that comes from. This 90-60 is this return stacking concept. The person who really started with Corey Hofstein with Newfound Research, and they have a slew of ETFs that are return stacked ETFs is what they're called. Wisdom Tree has a slew of return stacked products, and the product we help manage for them is part of the return stacking program. And then our client Rearview Capital use return stacking in some of their levered products. I would argue that's good leverage, but that is also something really interesting that's coming out, which allows investors to think about, instead of having to decide if I'm going to reduce exposure to equity or fixed income and potentially choosing the wrong thing, this allows them to not have to make that choice.
Okay, Shana, that sounds sexy to me. I don't know, but that sounds great. Do you have a ticker for the Wisdom Tree Fund?
It's not a fund, it's an ETF model. So you'd have to go to Wisdom Tree's website and look up their model marketplace.
Okay.
But I can give you, there's Corey Hofstein has an entire slew of ETFs that are this return stacking concept. You can just go to his website, just Google return stacked ETFs, and you'll find them. Our client, Rearview Capital, has a product called BEGS, which uses a return stacking concept to get Bitcoin and gold and silver. BEGS stands for Bitcoin, ETH, silver, or gold and silver. And they use return stacking to get 2 times exposure and to tactically make decisions, which I think is a really interesting concept. And you're going to see a whole lot more of this coming out.
Okay. So final question for you then. Let's talk about another alternative that's very popular, and that's Bitcoin. Right now, very volatile right now with the cryptos. And we did see a run up after President Trump was inaugurated for obvious reasons. What are your thoughts, though, on the crypto market? Is this a time to get in, or should people stay on the sidelines?
So there's technical aspects to why crypto should continue to have a tailwind and outperform. And I'm not going to do it as much justice as Matt Hogan from Bitwise does when he sits down and explains it. But the institutional adoption of crypto, Bitcoin and ETH being the biggest ones, is very early innings, right? And so I don't know how familiar your audience is with how these things work, but just because the Bitcoin ETFs came out does not mean that like you can go to your broker at Morgan Stanley and buy it. They have to get like home office approval, and they typically need 3 years and a certain amount of assets in those products before home office will even consider it so that they can be traded. And the vast majority of major broker dealers and independent REA aggregators, home offices, have not approved the use of these products. So anyone that's been putting money into these ETFs, and they are the fastest growing ETFs ever. They are doing so on their own. And so there's so much opportunity now once the broader adoption happens on the institutional level, and it will happen. This is a if, not a when, or a when, not an if. It will just, all the money that has already come in, there's a whole bunch of other money that's waiting to come in. And so the institutionalization of crypto, I think, is a tailwind, technically speaking, because it is a limited supply situation, especially with Bitcoin. If you have all this money going after Bitcoin, and I mean, they have to buy it, so they're paying up for it. That's how those ETFs work. With the creation redemption programs, you have to actually buy the underlying. And so that means that they're bidding up the pricing. And so the Bitcoin and crypto ETFs, I think, are a huge part of this. And I want to emphasize, I mean, like the actual physical backed spot ETFs, not these crypto buffer ETFs and all these levered crypto ETFs. Those are using futures, not the same thing. Has a different process, but the spot ETFs, and then more and more of these ETFs are going to come out as these crypto markets become more liquid and broader, and their market caps are getting bigger. I think you'll see Solana ETFs. You're seeing products that are staking to Solana and other things coming out little by little. Some of the newer registrations more recently have been with Solana, and you'll just see that continue to grow. There's a lot of private funds in the digital asset space and currencies that you might not be familiar with. The one caveat I like to talk about when I talk about crypto is the value of any particular crypto asset, whether it be Bitcoin or Ether or Solana or whatever, is based on the blockchain and the usage of said blockchain. So always be skeptical of a cryptocurrency that comes out that is not based, that doesn't have its own proprietary unique blockchain, right? Or not using a very well-established one. So there's a lot of cryptocurrencies that's blockchain is ETH. And then there's a lot of cryptocurrencies that are just meme crypto, and they actually have no blockchain behind them whatsoever. And so you just want to be cautious about that, because the value of crypto comes from the blockchain and the usage of that blockchain and how it can be used in other metrics. That's what makes ETH so valuable. And you want to look at like why that blockchain wins. Is it faster? Is it more secure? Like that's the argument for Bitcoin. It's the most secure, but it's not very fast. Whereas ETH is very fast, but is, has greater vulnerabilities. And look at all of those things to determine, what would increase the usage, because that's where the value of cryptocurrency comes from.
Okay, that is some great advice right there. I know the audience is going to get a lot out of that, Shana. Got to say, brilliant analysis today. You're one of the smarter guests that we had on the Money Path, so I appreciate it. Shana, how can the audience reach you?
Well, they can find me on all major social media platforms. You can find me on X. I don't have a sexy username on X because I built a following before I thought maybe I should change it, and before I was given the Queen of Alts nickname. So that's just Shana S621. Finance Queen 2020 on Instagram. I'm on LinkedIn. You can find me on all of the major socials. Just use my name. If you just Google me, they all pop up at the top.
Okay, I like that a lot. Well, the Queen of Alts. She said it all today. Shana, I got to thank you for joining me today. I definitely would love to have you back on the Money Path.
Absolutely. Thanks for having me.
Absolutely. Well, on behalf of Shana Sissel, I am Todd Schoenberger. Thank you once again for joining me. And coming up tomorrow is Bob Dole. He is the head of Crossmark. He was head of Invesco and Merrill Lynch at one time. Definitely want to hear what he has to say. He'll have a one-on-one with me tomorrow at 12:30. We'll see you then. Thank you.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.